Okay, good morning, all of you. Uh, Today is the first lesson of this semester, subject called financial management. Can you hear when I speak with you? Is it clear? Is it clear? I'll post there. Sangha, Chamal Mother Sangha. Is it clear?
Yes, sir.
Okay, right. Yeah. Now we will start. Up to now, there are 24 participants. So what happened to others? Will they join?
So there is a issue in Zoom.
Zoom, what?
The update, hacking scene and update is available.
I can't hear. Any problem in Zoom?
Yes, sir.
Isuru ni?
Yes, sir.
Yeah. What's the problem they have?
There is an update in Zoom, and people who didn't update the software cannot join.
Update. Can't you update?
Some of people didn't update yet. Sir.
Uh-huh.
They cannot join.
Anyhow, we will do the lesson today because time is going on. And I will share today recording through LMS, right? Any questions, you can post your questions in the chat box, the LMS, then I can answer, right? I think we'll start. Yeah, financial management. Subject code is AF3073. The first unit is introduction to financial management. So I'm the in charge for that subject. And right. Let's move to the session. Right. So today's learning objective. So explain the nature of finance and its interaction with other management functions. So as we know that there are a lot of other management functions like marketing, HR, administration, and there are many functions of management. Likewise, finance, the management function, right? Now we will explain the nature of finance and its interactions, relationship with other management functions. And second, review the changing role of finance manager and his explain the nature of finance and its interaction with other management function. And second, a review changing role of finance manager and his or her position in management hierarchy. And focus on shareholders wealth maximization. In simple, we say SWM, shareholder wealth maximization principle as operationally desirable finance decision criteria, and discuss agency problem arising from the relationship between shareholders and managers, and illustrate the organization of finance function. Yeah, now let's move. Uh, Important business activities, right? For a business, for an organization, it's a commercial organization. Uh, there are a lot of activities. Out of these activities, there are mainly three major activities. That is production function, production activities. If it is a manufacturing organization, they are involving production of goods and services. If it's a trading organization, they buy and sell, right? So buy the item. So instead of production, we have to consider as main activity as purchase, inventory, right? Making inventory. And second one, marketing. So once they have made production or they have purchased the item for the purpose of making revenue, they are selling the items to the consumers or customers. That is coming under the marketing. And finance means some money. In simple term, we can say finance is the uh, lifeblood of the business. Finance, so everywhere finance, you studied financial accounting, right? Everywhere the figures come up with in rupees or dollar, right, in monetary terms. So wherever you can find rupee value or any other monetary value, that is related with finance, right? Now we will understand what is real and financial assets, right? Real assets mean, say, you have a car, a property, plant, equipment, and let me say uh, real assets can be tangible or intangible. Uh, Tangible real assets are physical assets. Real assets can be tangible or intangible. Tangible means we can touch, right? We can touch tangible. Some assets are intangibles. We can't touch. But tangible real assets. Uh, Tangible real assets are the physical assets that include plant, machinery, office, factory, furniture, and buildings. And intangible real assets. It's a real asset. Real mean physically is available. You can touch, you can see, right? You can feel, right? Intangible assets include technical know-how. Technical know-how means how do so technical know means how do how to do the things, right? It may be manufacturing or some formulas or whatever. So know-how. Technological collaboration, say for example, uh, 10 years ago, uh, the two companies in manufacturing of motor bicycle, so for example, um, Hero is an Indian company and Honda is a Japanese company. Both of them come together and do the business. It's an agreement. It's a technical collaborations, patents and copyrights, which are real assets, right? Intangible real assets. So we can divide the assets into real assets and financial assets. Real assets mean the assets we can touch, right? The real assets can be divided into tangible and intangible assets. Real assets are physical assets. Intangible assets are uh, intangible assets are some agreements, patents, copyrights, as much. And the financial assets are also called as securities, right? Securities, financial papers on or instruments such as shares and bond or debentures. Say if you have additional money, you can put that money into the bank in a fixed deposit, right? That time the bank will give you a certificate, right? A certificate. That certificate is an evidence, right? So you have to surrender, you have to submit that fixed deposit certificate to the bank at the time of withdraw the money. So even though if a 1 million or 10 million or 1 billion, so they have given you a certificate. So that's an asset. So financial assets. That is the very document, evidence that you have deposited a certain amount of money into the bank. For that amount of money, you are the owner, right? For that, the bank has given you evidence document called fixed deposit certificate, that fixed deposit certificate is kind of securities, right? Security. So it's coming under the financial assets. You can purchase shares in a company, in a stock market or somewhere other institute, or you can purchase debentures, right? Debenture 1 million, 100 million, or whatsoever amount, right? So that is you have invested. For that you have get an evidence, right? So that is example for securities, right? So these are the financial assets, right? Equity and borrowed funds. Equity and borrowed fund. Equity means companies, right? So it makes noise from students' microphone. Therefore, I have muted all of your microphone. So if you have any doubt, you can raise your hand in the chat box and you can ask questions, right? So equity and borrowed fund. So when you see the financial statements of financial statement, especially the balance sheet, and nowadays we say that balance sheet, the name is statement of financial position, right? Statement of financial position, where you can find asset side and liability side. Liability side, there are two things: equity and liabilities. So equities are the amount of money, right? Amount of assets, amount of money that belongs to the shareholders or the owners. And the bottom of the statement of financial position, the balance sheet, so long-term liabilities and short-term liabilities, sometimes called as current assets. So the top part is equity that's belongs to the owner, and the borrowed fund is external liability, right? It's raised in the form of, right? Yeah. Shares represent shares represent the ownership rights of their holders, right? Shareholders are the owner of the company. The shares can be can of two types. It may be equity shares and preference shares, right? Equity shares and preference shares. Then loan, bonds, or debt represent the liability of the firm towards outsiders, right? Represent the loan, bond, or debts. So it's a represent liability of the firm towards outsiders. Lenders are not owners of the company. These provide interest tax shield, right? So important term here called interest tax shield. We will discuss about this term interest tax shield in detail under the chapter called capital structure, right? So in that time we will discuss, right. So equity and borrowed funds, there are two things: shares, that's the ownership, right? Shares represent ownerships, and it has two types: equity shares and preference shares. And the loan or bond or debts represent liability. A company need to obligated to pay, right, to the third parties, outsiders. And equity shares are also known as ordinary shares. So it do not have fixed rate of dividend, right? So the shareholders, equity shareholders cannot demand for the fixed amount of dividend throughout the period. So even though the company make profit or not, the board of directors or at the general meeting, they will decide how much amount of dividend should be uh, distributed among shareholders. And another feature of equity shares is there is no legal obligation to pay dividend to equity shareholders. There are two things: it does not have a fixed rate of dividend, and also the shareholders the shareholders do not have rights or legal obligation to get a dividend from their profit unless they have decided to distribute profit from their general meeting. Preference shares have a preference for dividend payment over ordinary shareholders. Preference mean, so it's kind of preference, right? Uh, Preference over equity shares, right? Preference shares have preference for dividend payment over ordinary shareholders. They get fixed rate of dividends, right? And they also have preference of repayment at the time of liquidation, right? So the when we look at the differences between equity shares and preference shares, number one, equity shares do not have a fixed rate of dividend, but preference shares, they get fixed rate of dividend. And equity shareholders no legal obligation to pay dividends to equity shareholders, but the preference shares, they also have preference of repayment at the time of liquidation, right? So you have assume that among you there are two different types of uh, invest shareholders. The first group equity shareholders, second group preference shareholders, right? If you have the first group, they have invested in equity shares, so they do not have get um, a fixed rate of dividend over the period of time. And also at the time of liquidation means resolution, right? At the time of liquidation, uh, after settling all obligation to third party, yeah, at the time of liquidation, once the company settle all the obligation to the third party, a certain amount will be balanced that belongs to the equity shareholders. That amount can be distributed to the equity shareholders after distributing to the preference shareholders, right? If there are any balances after settlement of preference shareholders, the balance will be goes to equity shareholders, right? Finance and the management function. All business activities involve acquisition and use of funds. Here, there are two terms: acquisition and use of fund. The acquisition means for the purpose of running the business or establishment of the business or the expanse of the business, company or the organization needs money, right? So the company manager, finance manager can get the money in different ways. It may be in the form of equity shares or preference shares or bond or debenture or bank loan. So these are the ways of getting fund for the business. So that is called acquisition, right? In finance term, we say as source of finance. right? So acquisition, all business activities involve acquisition. And use of fund. Use of fund means the company already acquired fund. So by use the organization should utilize that fund for the purpose of making profit. So therefore, the fund can be used to purchase property, plant, equipment, or other financial assets, investment assets, or they can use that fund for the purpose of inventory or whatever the ways, right? So finance manager mainly involve two activities, that is acquisition of fund, source of finance, right? Acquisition, where the manager can obtain the fund for the business. Then they have to use that acquired fund. It may be for the purpose of uh, buying assets or any other relevant activities for the business for the purpose of making profit. Finance function Finance function makes money available to meet the cost of production and marketing operations. Finance function makes money, right? So yeah, finance function makes money available to meet the cost of production, right? If the manufacturing organization, they need inventories, right? So for the purpose of inventories, the finance department will allocate some amount of money for the production department, and they will bear the cost of production. And marketing operations, so there are sales and advertisements and delivery, and for that they need money. So therefore, the finance manager will allocate that money. And financial policies are devised to fit production and marketing decision of a firm in practice. Financial policies are devised to fit production and marketing decision of a firm in practice. Mean, so the company's major cost area is the production area, and the income generation function is marketing functions. So there are two things. The first one, production, is the way of spending money, and the marketing is the way of getting money. The financial manager is responsible to manage these two things, right? How much amount of cost has incurred, how much of money will be generated, right? So finance manager should make a policies to manage this production and marketing decisions. Yeah, finance function or decisions can be divided as follows: long-term financial decision and short-term financial decisions. So in the balance sheet, when we look at in the asset side, there are mainly two things. The first one, at the top, we can find non-current assets. Under non-current assets, property, plant, equipment, and long-term investments, right? So there are things. So those are the long-term non-current assets, long-term assets. And at the bottom of the asset side, at the in the balance sheet at the bottom, we can find at asset side, in the asset side, current assets. So that's it. So we can realize within 12 months, right? That's a short-term assets, right? How much amount of we have to allocate under the non-current assets? It's a long-term financial decisions coming under. And how much amount of we can allocate as dividend, sorry, as a inventory, as a receivable, and other things. How much amount of money we can keep in our hand. So this kind of decisions coming under the short-term financial decisions. Let's see one by one the long-term financial decisions. So long-term asset mix or investment decision or capital budgeting decisions, right? These are the synonyms for the long-term financial decisions. So it's a long-term asset mix. Asset mix mean so how much amount of money should be allocated to purchase property, plant, machinery. How much we have to spend to purchase land. How much we have to purchase. How much amount of money should be allocated for the purpose of office building, and how much amount of money should be allocated for the finance investment, right? Financial assets. So this kind of investment decisions coming under the long-term financial decisions. So it can be says as sometimes as long-term asset mix or investment decisions or capital budgeting decisions. And capital mix of financing decisions or capital structure and leverage decisions, right? In the uh, in the equity side, right? Equity and liability side, uh, that is the way of, right, the way of getting fund for the business, right? So the company can get the fund through equity shares, preference shares, and bank loan, and debentures, bonds. So in this there are examples of getting fund to the company, right? So that is the capital structure. How much amount of money we can generate it through equity shares? How much amount of money we can get from issue of shares, issue of bonds, preference shares? So the management, the finance manager should decide. So what is the mix? How much amount of equity we should maintain? How much amount of uh, preference shares? How much amount of bank loan? How much amount of debenture? So it depends on the decision of finance manager based on the circumstances of the company, right? Capital mix or financing decision or capital structure and leverage decisions, these are the names. And profit allocation or dividend decision, right? Once the company make profit, that profits the profit is belongs to the shareholders. So this profit can be utilized either for the uh, purpose of expansion of their business, uh, reinvestment in the business, or they can distribute that profit to the shareholders, right? So this decision should be made by the financial manager, right? And say in simple way, simple in simple word, we can say a profit allocation or dividend decision as how much amount of money should be allocated, how much amount of profit should be allocated as dividend, and how much amount of profit should be retained within the organization for the purpose of expansion for the future growth. The short-term financial decisions, short-term asset mix or liquidity decisions or working capital management decisions. So how much amount of money we have to keep, with how much amount of money, how much, so what's the portion of money we have to keep as current assets and current liabilities, how many days we can allocate for the uh, receiver, trade receivables, right? And how many, how much the discount we can, how much, yeah, we can give to the our debtors, and how many days we have to keep the inventories. So that sort of decisions, right, it's coming under the short-term finance decision. You have studied about working capital management, right? You might study working capital management. So there are Yeah. The short-term finance decision is about working capital management, right? So how much amount of we have to allocate as current liabilities, how much amount of money we have to allocate as current assets, right? So it's a decision about quick ratio, right? Current asset ratio, asset ratio, that sort of things, right? How much amount of money we have to allocate it for the inventory, how many days we have to keep as inventory, how many days we can allocate, how many days we can give to the settle for the debtors for the settlement of the debtors, right? That sort of issues. And in the current liability side, within how many days we have to the settle for the trade creditors, and how much amount of money we have to maintain as right. Yeah. um, yeah. Financial procedure and systems. For the effective finance function, some routine finance functions have to be performed. Some of these are supervision, receipts and payment, and safeguarding of cash balances. So as a finance manager, uh, they have to involve as supervision of receipts. Receipts mean how much amount of uh, money we are receiving from our uh, marketing or trading, and payments, how much amount of money we have paid, and safeguarding of cash balances. So assume that is an accountant, right? Accountant is coming under the finance function. uh, Custody and safeguarding of securities, insurance policies, and other valuable papers, right? And taking care of mechanical details of new outside financing, and record keeping and reporting. Finance managers role, right? Raising of fund, right? The company need money, so the finding the ways of getting money is the responsibility of the finance manager. And allocation of fund, right? uh, for the making profit, they have to do business activities, say manufacturing or purchase, making payment of salaries and other activities. For that, the finance manager is a responsible person to allocate that funds. And profit planning. So finance manager should decide on which investment opportunities they have to make investment, right? For that purpose, they are doing uh, NPV, investment appraisals, right? Investment appraisal to test whether investments is viable or not, and understanding capital market, right? The company's assets, company shares are trading in the uh, stock market in for example in Sri Lanka. So capital market is a Columbus Stock Exchange, right? If say for example, Arpico, if you are a finance manager of Arpico company, so the Arpico company's shares has been listed in the Columbus Stock Exchange. Then, as a finance manager, you have to observe what is how the price movement of the shares in the capital market, and also they have to observe, so what is the bank interest rate for the loans and uh, deposits. So they have to monitor, right, for the effective management of finance. And financial goals, right? There are many goals. Here we will look at financial goals of a company. The first one, profit maximization. Profit maximization means as much as possible, right? They have to increase the profit of the organizations. It's mean when we uh, when we see the balance sheet, not balance sheet, income statement, statement of financial performance, right? So effective management means they have to make profit after tax at the higher level. If a manager makes a high profit, it's mean they are performing well. So therefore, the objective of finance manager is to maximize the profit of the organization. And the second one, maximizing earning per share. Maximizing earning per share. So the argument is uh, even though the company makes higher amount of profit after tax, when we divide that profit by number of shareholders, number of shares, it can be less number of less EPS, earning per share. So the argument is that profit maximization is not the appropriate measure to evaluate the performance of finance manager. So therefore, they substitute earning per share to evaluate the performance of the finance manager, right? Wealth maximization. Right? This argument that both profit maximization, which means increasing profit after tax, or maximizing earning per share, are the not good indicators of uh, company's performance. So they suggest wealth maximization. Wealth maximization means uh, the shareholders invest their money on the company. So is uh, it the company's performance is reflected on share price in the market. If the company is a quoted company, their shares are uh, listed in the Columbus Stock Exchange in Sri Lanka, right? So if the company performs well, the company's share price will be increased. If performance is go down, the share price will be go down. When share price go up, increases, the shareholders assets value of the asset has increased, right? If share price is low, become low, then the share price of the manager, share price of the company is to go down. Therefore, the value of the wealth of shareholders will be go down. Sometimes they may be get lost, right? So profit maximization, if we do an example, right? right? Here, now the price of the share price today is
නෑ අපි විනාඩි පැය භාගයයි ඇත්තේ මම එච්චර වෙලා එහෙමද
right. The price of the share is 10 today. Today, right? Today's share price is 10. The number of shares, holding number of shares. Shares, say 1 million shares we have. Right? How much amount we have invested? Each 10 rupees shares we have purchased. Number of shares is 1 million. So therefore, right? Today price is 10 each shares, and number of shares we have purchased is 100,000, 1 million. So therefore, total amount we have invested today is 10 million, right? Now, after 1 month, right? After 1 month, after 1 month, now company has performance is high performance. Due to the higher performance of the company, after 1 month, share price has been increased as 80 rupees per share, right? 80 rupees per share. Then you have 1 million shares. Okay, 1 million shares. Now, how much your wealth today's wealth? How much your value of assets? So into shares equal how much? Your wealth now is 18 million. How much profit? Profit is equal. Yeah, this is today's value. Yeah, value after 1 month. So your profit is 8 million, right? So this 8 million profit within 1 month, right? Profit within 1 month. Assume that if the company performs badly, right? Bad performance, right? After 1 month, right? After 1 month. So due to the bad performance, company's share price go down as 2 rupees per share, right? Companies share price comes down from 10 rupees to 2 rupees. The number of shares is 1 million. Now, what is the value of your assets? Each two rupees of the share and into number of shares. Then your value is 2 million. Now, how much profit lost? 8 million loss, right? So this is the wealth, amount of wealth. Right? At the time of investment, its wealth of shareholder is 10 million. If companies performs well after 1 month, right, due to the higher performance, company share price has increased from 10 to 18 rupees. Therefore, their current wealth after 1 month is 18 million. Right? If companies perform badly, the share price come down as 2 rupees from 10 rupees, then the wealth is 2 million. So therefore, so whatever the high performance or bad performance or any for whatever the reason, all the times shareholders want to maximize their wealth, right? Their wealth. The wealth will increase. The wealth is totally depends on price of the share. So therefore, the shareholders all the times expected to be higher share price, right? Therefore, to satisfy the shareholders, finance managers' responsibility is to maximize the share price. Once he maximizes their share price in the market, then automatically shareholders' wealth will be increased, right? Now we'll see. Oh, right. Right? Yeah. And now we will move to profit maximization. Yeah, profit maximization. Maximizing the rupee income of the firm. That is called profit maximization. Right? Maximizing the rupee income of firm. Resources are efficiently utilized. Appropriate measure of firm performance serve interest of society also. And objections to profit maximization. So that's the weaknesses, right? Weaknesses to consider as a consider uh, why profit maximization is not good measure, right? So it's watch, right? It is watch. It ignores the timing of return. It ignores risk. Achieves perfect competition. It in new business environment, profit maximization is regarded as unrealistic, difficult, inappropriate, and immoral. Right. Maximizing profit after taxes. Right, the second one. Right, maximizing profit after tax or EPS. Maximizing EPS. So maximizing profit after tax or earning per share does not maximize the economic welfare of the owners, whether the company earn profit after tax or higher EPS or not. If it is not reflected on the share price, so the owners doesn't have any economic benefit on that figures, right? It can be used as a performance measure of the company, but anyhow, the shareholders does not have any economic benefit from that increases in profit after tax or EPS, and ignores timing and risk of the expected profit. Say it's not the real time things. Here, the manager, the shareholders should wait at least 12 months. 12 months, they have to wait for an accounting period to calculate the profit after tax or EPS. So they have to 12 months. So the share price is not reflect. If the share price is not reflected on these figures, so it's meaningless, right? And market value is not a function of EPS, right? The share price is not depends on, it is not totally depends on earning per share. And the maximizing earning per share implies that the firm should make no dividend payment. So long as fund can be invested at positive rate of return, such a policy may not always work. Here, the maximizing EPS implies mean. So the purpose is maximize the earning per share. Implies that the firm should make no dividend payment, right? So they are not distribute the profit among the shareholders. Rather, they are utilizing the profit for the future investments. So shareholders, that the shareholders are suffering. So they are unable to get dividend from their investments, right? But this kind of activities will increase the value of EPS. So due to that, the shareholders are not all the times are happy. Right? Whether the company earn higher profit or not, it is not reflected on shareholders' wealth. Then meaningless for the shareholders, no profit for them. Maximizing EPS implies that the firm should make no dividend payment so long as fund can be invested at positive rate of return. Such a policy may not work or may not always work. Maximizes shareholders wealth maximization. Maximizes the net present value of a course of action to the shareholders, right? And accounts for the timing and risk of the expected benefits. Benefits are measured in terms of cash flows. The fundamental objective of the organization is maximize shareholders wealth, maximize the market value of the firm's share. So if the company performs well, right? If the manager, say for example, uh, due to the government policy, tourism companies, uh, the government has provide uh, more motivations, incentives to the tourism related company. Then tourism sector will have an opportunity to grow. That time, share price of uh, the tourism companies will go up. Right? It's a real time. New managers comes to the company, that company's share price will be go up. If there are some strike in the company, right? There are employee strikes in the company, or if the company's product in the market getting a bad reputation, then it will be impact on the share price in the real time, right? So therefore, uh, we can say that shareholders wealth maximization is the superior objective of financial manager rather than maximizing profit after tax and maximizing earning per share. And need for a valuation approach. Yeah. Need for a valuation approach. Shareholders wealth maximization has a valuation model. The financial manager must know how much should a particular share be worth, right? They have to evaluate what's the worth value of the share. Upon what factor or factors should its value depends. So on what are the factors impact the value of the shares. And the risk return trade-off. Financial decision of the firm are guided by the risk return trade-off. The return and risk relationship